So the next topic we are going to see is the opportunity zone, which is a tax strategy most investors overlook. So this is a federal tax incentive program which gives you to provide investments in some designated communities, some backward areas where they want to improve the community. That is where they create this one, opportunity zone fund they create. So we have to, if you have some capital gain, without paying taxes on the capital gain, if you want to defer, you have to invest in this qualified opportunity fund account. This is completely federal and they invest in the opportunity zone projects. So the how this works is there are 3 steps towards it. First is temporary deferral of capital gains. So now you sell your property, you have capital gain, you're not paying any taxes, you're deferring your capital gain tax payment. The partial reduction of the capital gain. How does it work? If you hold that investment for 5 years, 10% of the deferred gain is excluded, and if you hold it for 7 years, 15% of the gain is excluded. I will explain you with an example to be a little bit more clearer. And third one is permanent exclusion of gains from the investment. When you invested, it was 1 million, but after 10 years, it should be for more than 10 years. It should be held for at least 10 years. So when in the 10 years period, it has grown by another 9 million and it became 10 million. This 9 million is tax free. So that's the basic major advantage of this. So if I go with an example, John sold a rental property. He had a capital gain of 500,000. So this year he sold a property. He has gain. He has to pay capital gains tax on that 500,000. But in the first step, he is investing into the qualified opportunity funds, and that has to be done within 180 days. When he invests into the qualified opportunity fund, the first benefit he is getting is tax deferral. So the current year he is not going to pay any capital gain tax. The second benefit would be partial reduction of the deferred gain. So if he holds for more than 5 years, it would be 10% reduction. So it would be 450,000. If he holds it for more than 7 years, it would be 15% reduction. That is a temporary. Now the third step, if that investment, when he invested 500,000, it grew to 1.2 million over the period of 10 years. So what is the gain you had? You got proceeds of 1.2 and you have invested 500,000. You had a gain of 700,000 and that 700,000 is completely tax free.
You have to keep the money in the fund for 10 years. So the last time they had these funds was when last time President Trump came, 2017 TCJA. At that time, same rule, 10 years. So those funds were created that are expiring at the end of 26. Right. That's why the new funds will be starting at the end of 26, 27. It's not something that you can do anytime. It's not something that you can invest today. It needs some pre-planning. So you can invest into the funds that will be starting. It's a fund that invests into opportunity zone. The other thing, the other downside over here, they are investing money into the areas where nobody wants to invest. That's why the government is giving a special benefit. So the return on the investment may not be as high. And just because these are the people who are doing it for a living, so you have a CEO, so the salary, the burden, the expense could be very high. So you just have to be careful as how much money you are trying to save and understand the prospectus, what are the load, what are the expense ratio that they have before you jump into this QOF type of investment.
So this 700K is tax free, right?
Yes,
what
tax
about
free.
500K?
500K you have to pay taxes. So if you go back, the first benefit is deferral of the key word is deferral over here, deferral of capital gain. The same concept with QSBS as well. Deferral of capital gain and then tax-free growth. When you sell it, you pay tax on the original capital gain.
If you have a capital gains in 2025, do you have a time limit to invest?
Yes, within 180 days.
By June 2026, you have to invest.
From the date of the sale of the first asset, when the capital gain was created, the idea is to defer the capital gain. The capital gain was not June 30th.
Whenever it is.
Whenever it is, I give you 180 days. Go back to 1031 exchange.
Similar
I
to
give you
1031.
45 days to identify the property, 180 days to the similar concept.
So all the 4 topics has something related to 1031 exchange.
So either we can sell it, the property, otherwise we can invest in QOF. Right?
No, you can sell it, and the proceed, the money that you got, you can invest that money into QOF. Yes, you had a question?
You can see that this earlier slide.
Yes.
So the capital gains deferred, right? When are we paying it? Are we paying it after 10 years?
Yes, for 10 years, after 10 years,
After 10 years?
Yes.
700,000, that's fine. Well,
We
no,
will
I want to correct it. So 500,000 is the money that you received. There has to be some cost basis over there. You bought it something. Let's say you bought it for 100, sold it for 500, then you invested 500. So in theory, the original capital gain that you're deferring is 400. Now, I'm just assuming that you got it for free, or it's a business sale. So you got it for 500, and then you invested it. So I'm simplifying it, but
At this
Plus,
time, can I go for 1031 for this 500K?
in this example,
After 10
1030,
years.
no. In this example, 1031 wouldn't be applicable. The question, ask yourself why. So if you go back to,
like kind of.
yes, you can do 1031 exchange with DST. The idea is your risk basis cannot change. When I invest into a real estate, tangible property with these realtors that we have in the room, then the risk is lesser than, is very different than investing money into a fund. So risk profile cannot change. Otherwise, the exchange is not happening. Meaning you cannot sell the primary home, buy the investment property, or buy something in India or sell it in India. Risk cannot change.